Hello, my name's John Gullo, Chief Investment Officer of Sanderson Wealth Management, and I'll be walking you through this quarter's 15-minute financial update. Please remember, you can pause, rewind, or stop the presentation at any point in time. Risky assets suffered deep losses in the fourth quarter of 2018. With losses greatest on December 24th, many investors spent Christmas morning nervous and concerned over what would transpire when the stock market reopened on the 26th. Fears of continued selling, however, were put to rest when a risky asset rebound began in late December and continued through the first 3 months of 2019. U.S. large company stocks, which had suffered most in the tail end of 2018, gained 13.6% in the first quarter. Foreign stocks experienced healthy gains as well, with foreign developed country stocks up 10% and emerging markets up 9.9%. It was, however, the most interest rate sensitive asset classes that fared best, with infrastructure and real estate holdings up 15.9% and 14.3% respectively. So what caused the risky asset rebound? It was the Powell Pivot, of course. Throughout the fourth quarter, markets were concerned about slowing economic growth prospects, as well as continued interest rate increases from the Federal Reserve. The latter fear was reinforced on December 17th when a Federal Reserve press release indicated, and I quote, "It was likely that the economy will grow in a way that will call for 2 interest rate increases over the course of the next year." Now, with steep losses occurring in the financial markets, the tone changed to one of patience in early January. In a series of speeches by Chairman Powell, the message no longer highlighted additional interest rate increases, but addressed the belief that financial markets were signaling concern and downside risk. The committee was now stressing patience, and in Chairman Powell's words, the ability to be patient and watch patiently and carefully as we see the economy evolve. With the Federal Reserve changing course, so did interest rates. Now, not all interest rates were affected. Short-term interest rates, which rose in 2018 from 1.44% in early January and reached 2.35% in November, ended the first quarter of 2019 a bit higher at 2.4%. In contrast, the interest rate on 10-year U.S. government debt rose during 2018 from 2.46% to as high as 3.24%, only to fall back to 2.41% by March 31st. Now you're probably thinking right now, did I hear him correctly? Are short-term interest rates lower than longer-term interest rates? The answer is yes, barely, but yes. Now that fact is leading many to worry that this could be the start of the dreaded inverted yield curve, a signal of bad things to come. But let's take a step back and start with, what is a yield curve? Well, in its most basic form, a yield curve is nothing more than a line that plots the interest rate, or yields, of bonds with different maturities at a given point in time. Here we have some historic data which plots the interest rate on government debt with maturities from 3 months all the way out to 30 years. You'll notice that as maturity increases, so does the interest rate paid to investors. This is what we call a normal yield curve. Now, when the yield curve inverts, as it did back in December of 2000, longer-term debt has lower yields than shorter-term debt. Typically, this occurs when the economy begins to slow, the Federal Reserve is expected to cut interest rates in order to stimulate the economy, and investors expect short-term interest rates to fall sharply as a result of the first two factors. At that time, debt maturing in 3 months had a higher yield than debt maturing in 10 years. But what about today? Today we have what is called a flat yield curve. There is very little difference between short-term interest rates and longer-term interest rates. So as I record this today, the yield curve is basically flat, but we have traveled into inverted territory a few times over the past couple of weeks, and this bothers some people. Why? Well, historically, an inverted yield curve has been a predictor of recessions. In fact, the interest rate on 3-month U.S. government debt has been greater than the interest rate on 10-year debt prior to every U.S. recession over the past 50 years. This chart takes a look at the topic a little differently than we did a few minutes ago and highlights the premium an investor receives for holding longer-term U.S. government debt versus shorter-term U.S. government debt, and this is over a 35-year period of time. During this time period, there's been 3 occurrences where that premium was negative. That is, short-term interest rates were higher than long-term interest rates. These are the periods where the yield curve was inverted, and all 3 periods were followed by a recession. That's the area highlighted in gray. Now please note, the yield curve inversion has typically lasted for several months prior to a recession, and this isn't the case today. With only a handful of occurrences, the yield curve would need to remain inverted for quite some time before it became worrisome as a recession indicator. As we shift our focus to the economy, one bright spot has been the labor market. Currently, the unemployment rate in the U.S. stands at 3.8%. Now that's a level we have not seen for a sustained period of time since the late 1960s. But in order to bring that level any lower, it's going to be very difficult. Sure, there are over 7 million job openings in the U.S. today, and only 6.2 million unemployed people to fill them. One would think we could fill all those jobs in a blink of an eye. But clearly, the data is telling us something different. There is a skills mismatch between those able and willing to work and those who are seeking to hire. And that is a problem that is very difficult to solve without additional job training and education. 2018 was also a good year for economic growth. Fiscal stimulus in the form of both tax cuts and increased government spending helped growth reach 2.9% for the year. Now, this was much higher than the 2.2% average we've experienced since the end of the last recession. Now, growth was great, but it was not necessarily level for the year. In fact, economic activity was strongest in the middle part of last year. And currently, it appears to be moderating as the effects of fiscal stimulus wear off. Looking beyond 2018 and into 2019, we are starting to see a slowdown in economic growth, and it's evident in manufacturing data as well as retail sales. Currently, both measures remain moderately positive, but with inflation hovering around 2%, increases appear to have more to do with changes in price rather than a true increase in demand for products and services. Housing starts, which have been weak for a few quarters now, may see a pickup in the next few months as the interest rate environment has become more favorable for would-be buyers. Should housing starts remain weak, though, in spite of the low interest rate environment, this would be a negative sign for the economy. In contrast to the first 3 economic indicators, weekly jobless claims remain extremely low. And when it comes to unemployment, fewer new filers is always better. So with weekly initial unemployment claims averaging less than 225,000 for an extended period of time, the job market is showing no sign of weakening anytime soon. Moving on to international affairs, the Brexit process continues to be a headache for both the United Kingdom and Europe as a whole. Following the June 2016 referendum, the UK was scheduled to leave the European Union on March 29th of this year. And as a reminder, the European Union is a 28-country political and economic union, and the key benefit is free movement of people, goods, services, and capital between member countries. Now, with no deadline in sight, the European Union has granted 2 extensions thus far. The first on April 12th, and later extending it now to October 31st. Although the debate is ongoing, there does appear to be 4 main options that are up for consideration. First, there's the European Economic Area, which currently permits 3 non-EU members free movement of people, goods, services, and capital, but for a fee. Second, there's the possibility of a customs union alone, which would provide the movement of goods and services without duty. Third, and perhaps the worst option for businesses, a hard Brexit. This would be where the UK regains full control of its borders, but loses access to that single market entirely. And finally, there's always the possibility for a second referendum and no Brexit at all. Either way, businesses in the UK and Greater Europe now face several more months of uncertainty. Shifting from Europe to Asia, China has been in the news quite a bit lately. At the heart of the issue is the balance of trade. As you can see, over the past 20 years, the U.S. has greatly increased the amount of goods we import from China annually, growing from roughly $70 billion a year to $540 billion. In contrast, there's only been modest increase in the amount we export to the Chinese. As such, our annual trade deficit with China now stands at over $400 billion per year. That's billion with a B. In order to remedy that problem, the Trump administration has imposed ever-increasing tariffs on China in order to force them to the negotiating table. While progress has been made, there are still several sticking points left to be negotiated. There are issues surrounding the timing of tariff removals, how much and what additional goods and services will be purchased by the Chinese, intellectual property protections, the end of forced technology transfers for U.S. companies looking to operate in China, and finally, a framework of how to monitor and enforce this agreement. As a reminder, while the negotiations with China continue, so do tariffs on billions of dollars of goods coming in from China. Tariffs that, in effect, raise the cost of doing business for many U.S. companies that source parts from China. Which raises a question. Is it worth it? Well, in the long run, many believe yes. Currently, large U.S. companies generate over 40% of their sales from foreign countries. If better trade agreements can be reached, it will be worth it in the long run. Over the past several years, sales from U.S. companies have only averaged an annual increase of 4.25%. That is less than 2.5% above inflation. As the effects of fiscal stimulus wear off, additional sales to overseas customers would certainly be helpful to American companies. As we wrap up the presentation today, so close to the April 15th tax deadline, I wanted to touch on some of the implications of the tax law changes. First, as many of you blue state residents have noticed, there was a cap on state and local tax deductions for 2018, and that will continue going forward. This is good for low tax, low service red states, but bad for higher tax, higher service blue states. Second, the Tax Cuts and Jobs Act was great for businesses, both large businesses and small businesses. Lower taxes mean larger profits. Now, how businesses choose to spend those profits, we'll have to wait and see how that one unfolds. Third, many working families received an unwelcome surprise when they filed their taxes this year: smaller refunds. When the IRS reworked the tax tables in early 2018, they reduced the amount of taxes withheld from most people's paychecks. This meant more money in your paycheck throughout the year, but less money in your refund check. While the total amount of tax paid by most families did not increase, the smaller refunds felt painful in the first quarter. You see, many families count on larger refunds as a forced savings mechanism. It's that extra cash once a year that provides funds for new appliances, house repairs, and family vacations. While the larger paychecks helped the economy in 2018, the smaller refunds may weaken the economy a bit in early 2019. Thank you for watching this quarter's 15-minute financial update. We hope you found it informative and interesting. If you have any questions or comments, please feel free to reach out to us. Have a great day.